we like to kind of tease out here when we look at kind of that impact over the first 10 weeks versus the last 10 weeks of recovery on a state by state basis, because we are seeing overall, as you highlighted the national number, when you dig into the state by states here, I just want to highlight these states that we've been watching: Alaska, Oklahoma, Georgia, Mississippi, and now California jumping into the top 5 states here in terms of the softest recoveries when you compare those two periods. In what you would expect to see a strengthening picture on the unemployment front, not necessarily the case for those 5, as they've only come down less than half in terms of the first wave we saw in initial claims versus what we're seeing now. So kind of prolonged pain there. Obviously, California going through its own issues when I think about moving in the wrong direction. But for more on what all this means for the overall economy and the market, I want to dig into this a little bit deeper with our next guest here. That would be Mizuho Securities Managing Director and Chief Economist Steve Ricchiuto joins us now. And Steve, when we look at this, as Emily was just highlighting there, obviously a lot of data to dig through here, but the main headline is it's not good when you think about the worst quarter on the GDP front since the 50s, basically. And when you kind of dig through all this, obviously the question is how quickly this recovery is deteriorating here as we move week by week. What's your take on the numbers we're getting today?
Well, you've asked a very, very important question right there. And I think when you delve a little bit deeper into the data, you get a better perception as to exactly what's going on. And the key thing that drove both the first quarter decline in GDP and the second quarter decline in GDP is the fact that service consumption collapsed. And that reduction in service consumption is more important than what's happened in any of the other components, because that's really what's driving the economy lower. And a lot of that has to do with healthcare related services and other related services that have been pulled down because of the lockdown environment that's taken place in a lot of these areas. And that's a good portion of the reason why the savings rate has gone up as well. So it's not that people aren't purchasing goods. They are. They're just not purchasing services. And the ability to go back to to purchasing services will be very, very critical. And I think once people get more comfortable with the environment, they get less paranoid about, the state of a second wave and things of that nature, you'll see that service expenditures come back very, very rapidly. It's just a question of when that confidence level moves back. And the fact that it is services tells you that a lot of that will come back fairly quickly once people's confidence is returned to the system. Yeah, with regard to the claims numbers, let me just go one thing. With regard to the claims numbers versus the continuing claims numbers, keep in mind those continuing claims numbers, even though they were up last week, are still down relative to where they were on July 3rd.
Yeah, no, good points there. And I just want to dig into what you're talking about there on the spending front a little bit more, because when we talk about if people feel more confident as we get improvements on the health front, that's a big if, because we've seen kind of this second wave playing out in Florida, Texas, Arizona, and California. And on that front, just want to highlight, even here in New York, where things have been moving in the right direction, we still haven't seen. I'll just highlight this one key aspect here, because Edison Trends compiled a chart looking at Uber and Lyft spending. When you think about people getting out there, that would obviously be a pretty important metric to dig into. And we're not necessarily seeing a V-shaped recovery there, only about a 36% recovery in New York, one of those areas that is doing pretty well here. So, I mean, when you think about this V-shaped recovery and kind of the statistics that we got before on the manufacturing front, a lot of different reasons to look into, I guess, what is going on with the V-shaped recovery. But when we look at the spending front, when you get into health concerns, and then you also get into the idea of a lot of these benefits rolling off here, mainly that additional $600 from the federal level for unemployed workers, I mean, it doesn't seem like there's a lot of catalysts right now to believe that the strength that we saw earlier is going to continue.
Well, I mean, I think this concept of a V-shaped recovery has been wrong all along. There was no sense that we were ever going to have a V-shaped recovery. And I think there may have been a jump to that conclusion. I think people are also missing or guiding from the fact that what's happening in markets relating to economic activity. Often what markets do are separated from the expectations of economic recovery. The markets have had more of a V-shaped recovery than the economy was ever going to do. And that's a function of where the level of interest rates are, and where the level of interest rates are going to be, and where the level of monetary policy accommodation is, and where that level of monetary policy accommodation is going to continue to be. So I think the disconnect between the market versus the economy is not atypical at this stage in a business cycle. It's a very, very traditional response that happens because, again, markets are forward-looking, where the economic data, to a great extent, is backward-looking. So therefore, arguing about a V-shaped recovery that you're seeing in the markets, why aren't you getting in the data? That's always what happens. Just like there's always this fear of a double dip. And when you go back and look at history, we've talked about double dip in every one of the post-war business cycles. And yet, getting a double dip is an exceptionally rare development. And I don't think you're going to get one through here either.
Yeah, and I guess that's kind of one of the weird things about this too, is that, not a lot of examples in the past you can point to and say, all right, we've got this kind of recession also going on in the same time cycle as a global pandemic and what's playing out there, since this is so tied to the health concerns. And we heard that from Fed Chair Jerome Powell yesterday with the FOMC decision there, again, keeping rates at the lower bound, but also kind of asserting investors are going to be doing everything they can to make sure that the economic bottom doesn't fall out here. But what's your take on how they've been able to kind of keep things in control here? Again, today we're seeing the third day of falling bond yields, and that's impacting financials here. But what are you seeing in the credit market and the way that they were able to step in early here to kind of get back to normal market function?
Well, there's two things. First of all, the pandemic is the cause of the recession. They're not independent events. They're totally locked together. And therefore, yes, as the confidence level changes, you will see the consumer spending on services come back. The Fed has done an excellent job at doing what it needed to do. This economy is going to be driven by financial markets. It's going to be driven by banks being willing and able to lend, and that's what's going to keep the expansion or the recovery ongoing and eventually transit us from a recovery to an expansionary phase. And the Fed did a very, very good job at ring fencing banks immediately, and they've done a very, very good job at reinstilling confidence in the financial market to the fact that companies have a fallback to go to. They have a backstop. And that's eased a lot of the pressures and concerns that unfolded initially in terms of this market environment. And therefore, the snapback that came back in the markets makes much more sense than anticipating a V-shaped recovery in the economy against the backdrop of the conditions we're dealing with, which is basically a pandemic environment.
Yeah, and that would be my last question to you then, because we're seeing what the Fed's doing, and that's working, playing out if you're going to use the market as a scorecard. When you think about the underlying economy, still even Jerome Powell putting pressure here on Congress to get things done. It sounds like, if you believe Mark Meadows, that we're nowhere close to a deal. Of course, Schumer and Pelosi are going to be meeting with Republicans later on today at 3:30. But if you think about what is still needed here, and we're seeing benefits roll off and a lot of the safety net here come off in the next 2 weeks if we don't get a deal. I mean, how important is that when you think about just on the precipice of recovery, that you would take this away, what that might do to not just the unemployment trend here, but also just the confidence that you were talking about of everybody else getting out and spending?
Well, let's understand two things. First of all, the savings rate is telling you that if it does happen to roll off, people aren't going to be scrambling for cash immediately. They've built up this large amount of savings that still has to be dealt with. That's number one. Number two, the second point that you have to consider in here is that basically I've never met a politician who at the end of the day will not vote for increasing or to give money back to individuals, especially in an election year. So the probability of us getting a fiscal stimulus program is exceptionally high, even though the politics right now says they're far apart. At the end of the day, politicians like to give money back to their constituents, and that's exactly what's going to happen this time through. And go back in history and find me a time that hasn't happened, and you'll be very, very hard to find one.
I know there are a lot of Americans watching this show hoping that you're right and right quickly here, but Mizuho Securities Managing Director and Chief Economist Steve Ricchiuto, appreciate you taking the time.